Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Tuesday, the 17th of December, 2024. So before we kickstart our Daily Dose of Market Insights, let's take a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future. And as well as this advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's have a quick recap what has taken shape yesterday in terms of economic data release and as well as the intraday performance of the various broad-based cross-asset classes. So yesterday we know that it's the day of PMI data release. That means, i.e., if you look at the economic calendar over here, we see a slew of flash PMI data. So this flash PMI data, why is it important? Because it's considered one of the major leading economic indicator or metrics that could actually give us a gauge of the health of the respective economy. So we are very much concerned given of our related trading instrument with the US, China. China will not did not release yesterday, released the week after, and Eurozone and as well as US. So if you look at the Eurozone manufacturing PMI flash data for the month of December, it's pretty much in doldrums, pretty much in a contractionary mode at 45.2. So if you look at the trend of the Eurozone manufacturing PMI data, give me a minute, a couple of seconds to let it load again. Okay, good. So it has been contracting since June this year for the last 6 months. So anything that's below 50 right, is contraction. And if you look at the trend, the 3-year trend, okay, is rather lackluster, shaping a series of lower high. All right. So what it means that over here is that the Eurozone economy is on a very weak footing. And we know that Eurozone is pretty much dependent on more of their external economy. That means they rely on exports to drive Eurozone economic growth. And with this state of lackluster manufacturing PMI data out from Eurozone for the month of December, and this is considered as a leading indicator or leading, we call it a fundamental indicator, that implies that next year the ECB will likely to be more dovish. All right, or they got to be more dovish, okay, to be in a recession fighting mode. And in a longer term to medium term, that is actually implies a weakening euro dollar. Okay, let me stress again, that is a medium term to longer term trend of the euro dollar. But on an intraday basis, where I covered on intraday technical outlook, those are more of a very short term in nature, right? And it changes every day, and we know that price actually don't oscillate in a trend. Yes, it could be in a very major downtrend of the euro dollar, but in between on the intraday basis, we may see some spikes of counter trend mean reversion rebound, which indeed has taken shape yesterday, which I highlighted in my daily dose as well. So more about that when I covered the intraday technical outlook segment of the euro dollar. All right, so now let's look at other region PMI data. So for UK over here, also the manufacturing numbers are also weak as well. 47.3, way below expectation of 48.2, and also below the previous month of 48. And even though we start to see the services PMI data, yes, it came up at 51.4, slightly above the make or break level at 50.8. It's slightly also above the expectation of 51. But however, if you look at the trend of the global services PMI data for UK for the month of December, so this is a flash data as well. Okay, it's rather lackluster as well. So if you look at on the average, it's actually trending downwards since August this year. Okay, so look at the 3-year trend, okay, it's actually trending downwards. So what it means that over here is that, do not forget, Bank of England is also one of the rather staunch central bank that is still pretty much concerned about sticky inflation. But given the fact that the services PMI data coupled with the manufacturing, which is really trend in contractionary mode, services, yes, it's still above 50, but it's trending downwards. That means the growth rate is starts to slow down. So that also implies that there is some demand slack has already been seen in the UK economy, and that could also potentially force the Bank of England to actually alter its much more we call it a staunch approach in what I call inflation cautious mode into a much more what I call a recession fighting mode as well. So that also potentially or could see the sterling dollar weaken against the sterling weaken against the dollar from a medium term perspective. Right. Like I said again, in a very short term intraday perspective, the sterling dollar still has the risk of shaping that ongoing corrective rebound, which I highlighted yesterday in our daily dose of market, in our intraday technical outlook. All right, so I'll cover that in a fair bit later on. All right, so the key thing I will stress yourself over here is that fundamental is only impacting the medium term to longer term trend of whatever tradable instrument. So the short term intraday movement is all dependent on flows and technical factors. All right. Okay, now what about US? So if you look at US, it's still pretty much in a healthy shape, and we know that US 3/4 of their economic growth are driven by services activities. That means the services PMI is much more important compared to the manufacturing PMI. So the manufacturing PMI continues to contract at 48.3, below expectation of 49.8, and above below the previous month of November at 49.7. But however, the services side of the industry, which is much more important to the US economy, while like I mentioned earlier, 3/4 of the US economic growth is driven by services activity, which is being represented by the services PMI gauge. So this leading indicator, services PMI, the flash number for December actually rose much more than expected. Market is expecting at 55.7. However, it's recorded a red hot number of 58.5 above 56.1 that was printed in November. So if you look at the trend of the services PMI data for US, it has been in a rather robust uptrending phase, all right, since April this year. When you look at the 3-year trend, very clearly it's in a very clear, strong uptrend. So what does it mean? It tells us that the US economy is in much better shape versus the other developed nation economy. So from a medium term perspective, that also support the ongoing outperformance of the major US stock indices against the rest of the world. And as well, when that happens, the Fed will be likely more dovish in the upcoming 18th of December meeting, FOMC meeting, which is early Singapore time, Thursday timing at around 3 a.m. Singapore time. We'll talk more about that as we approach this tomorrow. So given that this very strong services PMI data out from the US, that also potentially could support a firmer US dollar trend or a US dollar strength trend in a medium term perspective. And that has been actually been translated in this movement. A very strong push up on the services PMI data has been reflected in the movement of the major US stock indices, where the S&P rose by 0.38%. The high performer or the top performer again that has been persistent in the last 2 weeks has been the Nasdaq 100, up 1.45%. So this Nasdaq 100 up 1.45% has been driven by the mega cap stocks, all right, which is the likes of Microsoft, Apple, Amazon, Tesla, and Google, and some from metal as well, which is up 0.63%. So all these mega cap stocks has a higher weightage in the Nasdaq 100 versus the S&P 500. So that actually explain the persistency of this Nasdaq 100 outperformance that has been in place since about 2 weeks. All right, so it's up 1.45%. Or the Russell 2000 also managed to actually inch up higher as well at 0.64%. However, the Dow Jones Industrial Average was actually quite lackluster, managed to actually we call it lose print a marginal loss of negative 0.25% due to the underperformance of the banks and the healthcare sector, right? Because the healthcare, one of the healthcare stocks is the top, the UNH, which is down negative 4.22% yesterday. So this United Healthcare is actually one of the major component stock in the Dow Jones Industrial Average. And how do you find out? By just going this free website called slickcharts.com. It's not updated live, but it's updated about 1 day lag, but which is sufficient for us to actually see how does company contribute to the aggregate performance of the Dow Jones Industrial Average. So you see over here that the top three weightage stocks, Goldman Sachs Group, which has a weightage of 8%, and United Healthcare United Health has a weightage of 7%. So look at the situation over here is that United Health is the culprit that causes the Dow Jones underperformance yesterday. Together with GS, Goldman Sachs was almost up marginally, only 0.14% yesterday. All right, so that actually explained the intraday underperformance of the Dow Jones Industrial Average yesterday. The other three major US stock indices managed to actually close in the green, and the continuity of the persistency of the Nasdaq 100 outperformance continued yesterday. And how about the dollar? So the dollar continues to gain strength, only against two currency, the dollar yen yesterday and the dollar Swiss franc, but against other major currency, that means against the sterling dollar, against the CAD, against the CNH, against the Aussie, and against the dollar, against the euro, the dollar strength has started to temper off yesterday. So that also came in within our expectation as well. So if for those who followed my daily dose of market insight yesterday, I do highlight that the intraday technical outlook of the dollar strength is actually due for a potential setback. Okay, after last week a strong push up in terms of the dollar movement, right? That has been playing out as expected. So later I'll touch more on the intraday technical outlook on the FX market to see what are the refresh new key levels to watch on the dollar major pair. All right, so that pretty much sum up what has taken shape yesterday. And one more key news to share, in fact, it could potentially impact the European stock indices, is that it's now been confirmed that an early election for Germany will be held on February the 23rd of February, as the current Prime Minister over here, or Chancellor they call it in Germany, loses a confidence vote. All right, over here, ending the coalition in the parliament, in the German parliament. So with that create a bit of uncertainty in the Eurozone, and that could also potentially see a weakened euro dollar as well, as due to heightened political risk in the Eurozone, the ECB may be forced to be more taking the slack of introducing more expansionary monetary policy to negate ongoing potential recession-like scenario that is getting higher and higher in the Eurozone economy. Like I share with you all the weakness of the aggregated Eurozone manufacturing PMI data, and as well as the slowdown in the growth in the services PMI data as well. All right, so yes, that actually explain the intraday, no, that actually sum up the intraday movement of the broad-based cross asset classes that I want to share with you guys, and as well as the key news flow and event that has taken shape yesterday. All right, so with that, now let us now jump into a intermarket dynamics that could take shape over a medium-term horizon. So this intermarket dynamics that I would like to share with you is more pertaining to the dollar yen. So it's important. Why? Because we know that this coming Thursday, which is on the 19th of December, BOJ will make its latest monetary policy decision. And by looking at this interdynamics chart, where I plotted against the US Treasury yield minus the 10-year JGB yield. So this is the yield spread between the 10-year Treasury yield and the 10-year JGB. And at the bottom is the shorter term tenure of the 2-year Treasury yield minus the 2-year JGB yield. And the bottom of the chart in purple is the dollar yen rate over here, the dollar yen rate. So you record, if you could see over here that since 16th of September this year, the yield spread between the Treasury and the JGB, both on the 10-year and the 2-year, has started to tick upwards, right? Tick upward. That means indicating that the US Treasury yield is moving at a faster rate than the JGB yield. Okay, that means they are actually in a yield premium. So that means the US Treasury yield premium has widened against the JGB yield premium. Okay, this is what it means. So the widening of the US Treasury yield, the widening of the yield premium of the Treasury against the JGB yield put upside pressure on the dollar yen rate. Right, it put upside pressure on the dollar yen rate, and you recall that over here. Let's just look at the chart. At this point in time, on 14th of November, there's actually a setback on the dollar yen. Okay, there's a setback, and this setback on the dollar yen actually also correspond to the Treasury yield spread, the yield spread of the Treasury versus the JGB has starts to narrow. Okay, it inch downwards over here, and the last few days, and in fact yesterday, it starts to shape a lower low, lower high. So this high, lower than this high, right below this descending trend line that I drew, and the 3.7% medium-term resistance. Okay. Oops. 3.7%, and very clearly on the 2-year as well, the 2-year yield spread between the Treasury yield and the JGB yield, it has started to shape a lower high as well below the key medium-term resistance of 3.84. Okay, so what it means that over here right now the dollar yen is also coming to test this descending resistance as well, and also about to shape a potential lower high. So what it means that the dollar yen now is in fact at an inflection level where it could actually break up, or it could start to push downwards. All right, why? Impacted by the movement of the yield spread between the US Treasury and the JGB yield, both on the 10-year and the 2-year, also coming close to inflection levels as well, which is at 3.7% for the 10-year yield spread and 3.84% for the 2-year yield spread. So if BOJ starts to be more hawkish on Friday or on Thursday, that could potentially see a very clear lower high on this yield spread, and that could also exert downside pressure on the dollar yen, at least to see a multi-week corrective decline unfolding on the dollar yen. So something to take a note of in this intermarket analysis. Why? Because the determinant or the factor that is driving the dollar yen is now at inflection levels. All right, so with that, that sum up the intermarket dynamics analysis that I share with you all pertaining to the FX market on the dollar yen rate. And it's important. Why? Because we do have a key risk event that is taking shape on this Thursday, which is the Bank of Japan monetary policy decision. All right, so with that, let me now expand my screen and we will jump straight into the short-term intraday technical outlook segment on the broad-based cross asset classes that we cover on a daily basis. Okay, give me a couple of seconds. All right, let's start with the euro dollar. So I mentioned the euro dollar indeed shaped that rebounds, and almost hit the first resistance level at 1.0540, and is now attempting to break above the 20-day moving average as we are speaking. So still no change, still maintain that intraday bullish bias for that mean reversion rebound scenario to play out within its medium-term downtrend that is still intact, which I explained to you earlier, supported by fundamental factors as well, which is a very weak Eurozone economic situation. 1.0460, that is my short-term pivotal support on the euro dollar. Above 1.0540, the next two key resistance level to watch on the intraday basis will be 1.0570, followed by 1.06 figure level, 1.06. All right, only a push down and an hourly close below 1.0460 that would invalidate today's intraday bullish bias to eradicate the mean reversion rebound scenario, and this is where the bears will resurface to continue its impulsive downward sequence within its medium-term downtrend phase. In first step, exposing the next near-term support level at 1.0410, followed by 1.0330 next, which is the minor swing low of 22nd of November. Flipping our attention will be the sterling dollar. So the sterling dollar over here continues to push up as expected, and surpass the 20-day moving average, pardon me, and surpass the 20-day moving average during yesterday US session. And right now, as we are speaking, it's still trading above the 20-day moving average. All right. So those who are new to TradingView, this is an hourly chart, but in TradingView, we do have the ability to overlay a higher time frame moving average or technical elements on a shorter time frame chart. That means, yes, we are looking at the intraday movement using the hourly chart to depict the intraday analysis, but overlay it with a higher time frame moving average. So that could actually give us kind of what I call multi time frame analysis, you just using a single chart view on the hourly time frame. So pretty much convenience that TradingView offers us, okay, of such a benefit. So with that, the first support level to watch will be 1.2675. We also confluence with the 20-day moving average now acting as an intermediate support, but I do not want to put it so tight as my short-term pivotal support level. So today's short-term pivotal support will be slightly higher at 1.2640. Why 1.2640 is important? Because this is a very clear congestion area. Breakout yesterday, tested over here. Look at this long shadow, this long black shadow during the start of the US session. There was an intra-hour sell-off, but this sell-off managed to actually close higher, and thereafter it shaped a hourly Marabuzu candlestick, and price action starts to consolidate above the 20-day moving average. So this is kind of a very important psychological level where at that point in time it managed to attract a bout of buying pressure or bullish pressure on the sterling dollar on the intraday basis. So with that, using 1.2640 as my short-term pivotal support for today, still maintain that intraday bullish bias for the mean reversion rebound to continue to play out. First resistance level to watch, 1.2720, no change. Above it exposes 1.2680 level, which is the minor swing high of 11th of December, and as well as the pullback resistance of this former minor ascending trend line from 22nd of November low. It's only an hourly close, and the push down below 1.2640 will invalidate today's intraday bullish bias. Pardon me, I repeat again, only an hourly close and a breakdown below 1.2640 will invalidate today's intraday bullish bias to flip the narrative back to the best for another round of impulsive downward sequence to resume, exposing 1.2610/1.26 figure level. A breakdown below it sees the minor swing low of 22nd of November and 26th of November coming in at 1.2510 next. Right, so that sum up the sterling dollar intraday technical outlook. Now, turning our attention will be the Asia Pacific currency, starting with the dollar yen. So the dollar yen is almost reached our resistance level that we highlighted yesterday, also top of this ascending channel, which is 15470, 155 figure level. And what's interesting over here is that the price action on the hourly RSI has started to shape a bearish divergence, and right now it's attempting to actually test this support level as well. Okay, that's the support level. Okay, so what I'm doing over here is that given this bearish divergence that has already taken shape and is coming very close to the resistance level that we highlighted, i.e. there could be very little potential upside right now on the intraday basis. So yes, there could be a bit of residual push coming close to the 15470. So in fact, I will use this zone over here to actually potentially fade the move. 15470/155 figure level. So that will be my short-term pivotal resistance zone, flip to a intraday bearish bias for a potential mean reversion decline scenario taking shape in the first step. First resistance level to watch will be 15350 level. So that is the level that managed to survive during the European session and as well as the Asia session as well. So a breakdown below 15350 for sure is also a breaking down below this minor ascending channel support level that is in place since last Friday. So that could ignite a much we call it pronounced intraday mean reversion decline scenario or mean reversion setback scenario to expose the next support level at 15270. Below it sees 15190, which is pretty key. Why? Because that almost confluence closely with the 3 moving average, the 20, 200, and the 50-day moving average. Only a push out with an hourly close above the 155 figure level will invalidate today's bearish bias for that intraday mean reversion decline or setback scenario to unfold and kickstart the bullish momentum on the dollar yen, exposing the next near-term resistance zone at 155.85/156 figure, which is a one-time Fibo extension, and as well as the minor swing high of 20th of November. Above it sees the minor swing high of 15th of November at 15675/157 figure, which this is the 1.236 Fibo extension. So that's for the dollar yen. Now, turning our attention will be the Aussie dollar. So the Aussie dollar, I will still continue to use the 63 figure level over here. So, but however, price action now seems to be rather weaker in terms of the recent movement that's being seen yesterday. So with that, I will actually flip to a neutrality stance for today. Okay, seems because price action can't break above it. Last Friday swing high. All right, it can't break above this last Friday swing high. Okay, so with that, I'll turn a neutrality stance. This 63.40 and 63.80. Okay, all right. So neutral between 63.80. Why? Because yesterday movement can't break above last Friday minor swing high, whereas the euro dollar, the sterling dollar all managed to push up higher. So this Aussie dollar momentum is rather weak, so it's not following the trend of the euro and the sterling that is getting much tad bit stronger on the intraday basis against the dollar. So with that, no conviction to maintain that intraday bullish bias on the Aussie dollar for today. So I will flip to a intraday neutrality stance instead. So neutral between 63.80 and 63.40. Only a push up and an hourly close above 63.80 will reinstate that bullish bias for that mean reversion rebound scenario to play out. Next resistance will be 64.35 followed by 64.70. That confluence very closely to the 20-day moving average in between. All right, but however, if price action starts to plummet below 63.40, then we will see the very we call it a weak out layer on the Aussie dollar to actually see a start of a potential multi-week impulsive down move. In first step, the next support level is 63 figure slash 62.85. So why this area here is very important, the 63.40 is on the intraday basis. So if you look at the Aussie dollar on the daily time frame, is now testing the 63.60 level. All right, so every time it tests since last Wednesday, Thursday, Friday, Monday, it managed to have a daily close above the 63.60, right? When you survive. So if today it break down on an intraday basis and as well as have a daily close below 63.60, then the odds will skew towards the bears, and this bear will be a much more forceful bearish force because this 63.60 is a major support level. Why major? Because previously on three occasions, 5th August, 19th April, and 26th of October last year, every time it 10th of November last year, every time it managed to actually shape multi-week bounce of it. And where it bounces, it also bounces off the major ascending trend line from 13 October 2023 low, because from this low onwards, close to a year, the Aussie dollar is being trapped in this complex sideways trend. If the Aussie dollar managed to have a daily close below 63.60, that means it already exited on the downside from this year-long of complex sideways trend. So implying from a technical perspective is a major bearish breakdown that could imply or translate into a multi-week impulsive down move sequence. So that is actually one of the outlier that is taking shape in the FX market right now. That means the Aussie dollar is kind of more weak against the other currency like the euro, the sterling. All right, over here. Okay, so now that's actually sum up the FX market short-term intraday technical outlook. All right, so with that, now let us focus our attention to the major stock indices, starting with the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index for today, it has very clearly a daily close below our short-term pivotal support level yesterday at 19,770, and very clearly also break down below the 20-day moving average, it also break down below the minor ascending trend line from 26th of November. So indicating that this push up on 9th of December due to that we call it positive news flow, where China top policymaker promised again to ignite forceful fiscal stimulus measure in 2025. So I guess market participants now has turned the dynamics back to a bearish bias, indicating that they are losing patience of such promises or just words, and what they want to hear is actual implementation from there. So with that, I got to flip to a bearish bias and respect the price level, at least on the intraday basis. So using 19,960, which is the pullback line of the former minor ascending trend line support, now turns to a pullback resistance and close to the minor swing high of last Friday US session high as well. So 19,960 short-term pivotal resistance level, flip to a bearish bias for today. Next near-term support level to watch, 19,337. All right, only a push up and an hourly close above 19,960 will invalidate today's intraday bearish bias to see a retest on 20,300 / 20,520 next near-term intermediate resistance zone. Okay, so that's for the Hong Kong 33. Now, turning our attention will be the Japan 225. So the Japan 225 yesterday, okay, or in fact at the start of today's Asia session, managed to hit our first resistance before trading lower, but still managed to hold above the key short-term pivotal support level that we highlighted earlier yesterday as well, 39,480 / 39,230. Still no change, using 39,480 / 39,230 as my short-term pivotal support level, maintain that intraday bullish bias. Only a breakout above 39,830 potentially sees a further impetus to revisit the medium-term sideways range resistance at 40,155 / 40,280. Right, so very clearly since the low of 27th of September. Since September, it has been trading in this complex sideways range, and the upper limit of this medium-term complex sideways range is 40,155 / 40,280. However, if price action break down below 39,230, then today's intraday bullish bias invalidated for a further push down towards the lower limit of this sideways contract range, range configuration, pardon me. In first step, exposing the next near-term support level to watch should be at 38,990, 38,670 on the intraday basis, which correspond to the three key moving average as well, the 50, the 20, the 50, and as well the 200-day moving average. Now, what's up next for the German DAX? So the German DAX yesterday also rather weak as well upon the outcome of that chancellor, the German chancellor, losing a confidence vote in the German parliament, and him being forced to call an earlier election for Germany in February next year. So that take up some of the bullish, we call it momentum in the German 30 index on the intraday basis. So still no change, still hovering above the 20,260 short-term pivotal support level. And what we could see now, there's a bullish divergence that has been formed. I will be more skeptical right now of this bullish divergence. Why? Because now it's the Asia session. The futures market for the German DAX has yet to be open, so there's lower liquidity right now. So it's only open at 3 p.m. Singapore time. So until with the start of the German DAX futures opening session at 3 p.m. Singapore time, then we could have a better gauge on the price movement of the German 30. So yes, there's a bullish divergence right now on the RSI, but I'm quite skeptical of it. But nevertheless, it's still holding above the 20,260 short-term pivotal support level. So still using this short-term pivotal support level, still maintain that intraday bullish bias, but I have two resistance level to watch right now. Okay, so the first resistance that it got to surpass will be this area here at 20,360. Only above 20,360 sees a retest at the current all-time high area of 20,470 next. However, if price action starts to push down below 20,260, then this intraday bullish bias will be invalidated to kickstart the corrective pullback scenario or sequence, exposing the next near-term support level at 20,155, followed by 19,960 next, which is the lower limit of this minor ascending channel from the low of 19th of November, and as well as coming close to the rising 20-day moving average as well. Now, major US stock indices, starting with the Dow Jones Industrial Average, the Wall Street 30. So the Dow Jones 30 broke below our short-term pivotal support and traded lower. So with that, it seems to us that the bulls are being put on hold, and right now is fast approaching the rising 50-day moving average, which is confluencing with the minor congestion area of previously 15th of November. That was to 19th November, resistance break, potentially now turns into a pullback support, also conferencing at the 50-day moving average, which is 43,510. So given it's a rather weak upside momentum, I do not want to be so bullish right now on the US Wall Street 30. So flip to a neutrality stance, 53,510 and 53,820. So that was yesterday's short-term pivotal resistance, now turns into a resistance level, and that also managed to induce this long hourly candlestick or at the close of the US session yesterday. So with that, flip to a neutrality stance, neutral between 43,820 and 43,510. Only an hourly close above 43,820 potentially could validate an intraday recovery on the US Wall Street 30 to see a potential bounce, exposing the next near-term resistance level at 40,040, followed by 41,195 / 44,350. Next, so that's the US Wall Street 30. With that, the Nasdaq 100. So the Nasdaq 100 continues to remain rather bullish, hit our two resistance level that we highlighted yesterday, 21,950 / 22,036, 22,130 / 22,160. All right. So right now, this will be potentially be a pullback level to watch. Over here at 21,950, but I don't put it so tight using the inverted V shape here. Previously minus swing high, now turns into a pullback support, slightly lower at than 21,950, which is 21,860. So this level here will be my Titan key short-term pivotal support level for the Nasdaq 100, still maintaining its intraday bullish bias. Hourly RSI is being overbought over here, so right now potentially there could be a pullback first. No clear signs of bearish divergence, so potentially there could be a minor pullback support level 21,950, maximum the short-term pivotal support level at 21,860. So as long 21,860 holds this potential minor pullback that could take shape due to its extreme rather high overbought level on the hourly RSI at this point in time. After the pullback take shape, potentially it should resume its impulsive up move above 21,160, exposes the next near-term resistance zone at 22,366 / 22,476, which is defined by a Fibo extension cluster level. Only an hourly close below 21,860 will invalidate today's intraday bullish bias to see a much more pronounced, deeper intraday pullback or mean reversion decline sequence or scenario, exposing the next near-term support level at 21,650. A breakdown below 21,650 sees a deeper pullback, exposing the next near-term support level at 21,400. So once this level is in fact the minor swing low of 6th of December and 11th December, and so coming close to the rising 20-day moving average as well, pardon me. So that sum up the intraday technical outlook on the major stock indices. So now let's shift our focus to the commodities market, starting with gold XAU / USD. So for gold XAU / USD, initially we are looking for a direct rebound up towards 2,674. Then you have a short-term pivotal resistance at 2,690. But price action, yes, it bounced, then thereafter it traded sideways again. So if you look at the hourly RSI over here, it seems that it still has some more room to go to the overbought level. So indicating that at this juncture over here, that could still be a test at 2,674. Above it, potentially open up scope for 2,690. And the price action right now managed to actually try to hold above the 20-day moving average by shaping a series minor higher low you could see over here. So with that, what I want to actually do over here is to actually flip to a intraday bullish bias using yesterday's minor swing low area at 2,646 for this potential intraday mean reversion rebound to play out. Next resistance level to watch again, like I mentioned, 2,674 followed by 2,690. Only an hourly close below 2,646 will invalidate today's intraday bullish bias for the mean reversion rebound to get invalidated and resume the push down towards the bottom of its range. So it could be now trading in a minor sideways range configuration after this peak failed to break above the peak of 25th of November. That means that was last Thursday peak over here. If can't break above the peak of 25th of November, and it could plummet downwards towards the lower limit of this sideways range. So only a breakdown and hourly close below 2,646 short-term pivotal support level will invalidate today's intraday bullish bias to expose the next near-term support level at 2,631. Failure to hold above 2,631 on the intraday basis sees a further slide to revisit the sideways range configuration. Key short-term support level at 2,610, 2,613, pardon me, 2,605. So that's for gold, XAU/USD. And lastly will be the West Texas crude oil. So West Texas crude oil, yesterday we flipped to a bearish bias, and the bearish bias hit our the upper limit of our first support zone to watch, which is 7050/7005. That also confluence with the 50-day moving average. Hourly RSI continues to be rather bearish, continues to print out a series of lower high over here, lower high, and it's each down below the 50 level mark as well. So still continue the bearish bias for today on the West Texas oil. No change using 7170 short-term pivotal resistant level, pardon me. Breakdown below 70.05, which is the lower limit of the first support zone, exposes the next near-term support level at 69.30 in the first step, which confluence with the 20-day moving average, I think, as a support level as well. Only a push up and an hourly close above the 71.70 short-term pivotal resistance will invalidate today's intraday bearish bias to see a squeeze up to revisit the key medium-term resistance level at 73.15. Because this level has not managed to be taken out since 24th of October. So that's coming close to about 1.5 months of resistance. Okay, so that's for the West Texas crude oil, and as well as conclude our intraday technical outlook on the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So for today, during the European session, this is more pertaining to the UK economy, which could potentially impact the sterling dollar rate. All right, this will be UK labor data, unemployment rate, and employment change out at 3 p.m. Singapore time. And in Eurozone, we have economic sentiment index December that's out at 6 p.m. Singapore time. And for those who are looking at any Canada related FX pair, the Canada inflation rate will be out at 9:30 p.m. Singapore time. And also for the US, that could also impact the major stock indices, will be retail sales. Why retail sales is important? Like I mentioned, retail sales form part of the services activity in the US, which constitute close to 3/4 of its annual economic growth. So that will be out at 9:30 p.m. Singapore time, retail sales. And yeah, that's about it. So that's sum up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.